The low interest rate environment taking its toll on the banking sector. Morgan Stanley says it's planning to lay off hundreds of people in its fixed income and currencies divisions due to sharp declines in revenue. Joining us right now is the president and chief investment officer of Mendon Capital Advisors, Anton Schutz, who's been a longtime student of financial services and certainly an investor of the banks. Good to see you, Anton.
Always a pleasure.
First, your take on the Morgan Stanley cutbacks. Fixed income obviously has been an issue. Unfortunately, we're talking about more job cuts this morning.
Well, the rest of Morgan Stanley seems to be doing pretty well, particularly the wealth management side. So this continues to overshadow the profitability of the company.
Because they've shifted really the focus to wealth management over the last several years.
They really have. They've done a pretty nice job, and the numbers just aren't flowing through.
Right. They had a terrible quarter, though, most recently. It's not like, these guys are shooting the lights out. That's why they're obviously firing people.
But it wasn't in wealth management. The quarter was.
Wealth management is the bullish side.
Yes. Would they be firing the people at the wrong time, though? Now the Fed is raising rates, and you're going to see a pickup in the yield curve and net interest profitability and so forth?
Yeah, timing is really a question because with higher rates, the business become more profitable. However, the proprietary side of these banks, Dodd-Frank has really limited it, and I think that whole liquidity thing is going to come to bear when people rush for the exits and fixed income.
That's the issue. These companies are making money, but they're also being forced to put all this money in reserve, and that's putting a crimp in overall economic activity. Now, you've been really seeing lots of flows because you're right in the middle of some good takeovers in the banking sector.
Correct. My funds have had over 12 mergers this year, and we've started to see some decent-sized mergers. We saw Astoria here in New York go. We saw First Niagara go.
These
City
are small
National.
Regional banks that have been taken out.
They're multi-billion-dollar market caps. So,
isn't this like it's almost like all the growth slowing stories? When rates are surprising people to the downside and growth is slower, banks don't make as much money, as you very well know.
Right.
So shouldn't they all just merge?
Well, exactly. And don't forget about regulation, which is crimping profits.
Right.
A yield curve which isn't very favorable either. And think about all the the cyber work that they have to do, all the technology upgrades they have to do. So scale does matter.
Well, it's an interesting case.
Why the inflows, though? Is it people who anticipate the yield curve becoming more favorable to the banks? Is it because that they're desperate for yield because they can't get it anywhere with any kind of safety?
Well, if you think about performance this year, let alone my funds, just the index alone has outperformed the S&P pretty dramatically, especially the regional banks. And then if you look at past performance, you look at the regional bank index versus the S&P. Massive outperformance over time. And, we've had a lot of consolidation, so, we've beaten the indexes as well.
If you were the regulatory czar of the United States, do we have too much regulation, too little regulation? What would you do?
Well, pendulum has swung so far to the too much regulation side. I think it's really hurting the flow of money to businesses. And there was a great piece out recently that talked about the big banks are lending so much less to smaller businesses. They're letting these online.
Dick Beauvais wrote that yesterday.
Yeah. But isn't it perverse that, to Anthony's point, that the reason why you've had great performance is because of regulation and people need to merge, and because, to Dagen's point, you're not getting yield spread expansion, you're getting yield spread compression. Every fundamental reason from an earnings perspective to own the banks you wouldn't own. You'd own them because they need to roll them up.
Well, yes and no. There are parts of the country that have really great economic growth, the Southeast in particular.
Right, good point.
And think about tax policy, right? Look at the states that have very favorable tax policy, getting huge inflows of migration. Places like Tennessee, places like the Carolinas.
That's why we've seen acquisitions.
Yep. And, we're seeing very good, growth. Companies are relocating there. They want to be near the ports. Yeah. You've got a lot of good Southeast ports, Panama Canal. So my companies don't have to sell, but they're doing it anyway.
Speaking of selling, one of the funds you can short in.
Yes.
What do you short?
Well, I never name companies, but, I think
roughly.
I will. Morgan Stanley shorted this morning.
No, I'm not short Morgan Stanley. But I will tell you there are parts of the country, right? Again, I talk about Southeast being really robust. Yeah. Do you want to be long banks in the energy patch? Right.
I thought it was we're going to hear from Janet Yellen today. I thought she's going to tell us that the Texas economy is just rocking. It's time to raise rates, rocking them higher. Seriously. Texas banks, big problem.
Problem. Not big problem, but problem. Profitability is not going to be terrific. They've got to write some of this stuff off. And then I'm not just worried about direct energy loans. I'm worried about indirect.
Right.
What happens when, I was just talking to a guy in Dallas. I was in Dallas on Monday, and he was telling me about a hotel in the energy patch that was sold out for a year. and now they're 33% occupancy. Who's got that long? I mean,
stinky.
Yeah, that's a great point. So what about the Fed? Do you think the Fed raises rates? How does that impact the banking sector?
I mean, they have to raise rates. I mean, the market is believe they're going to raise rates. The market believed they're going to raise rates in September. They didn't. Look what happened.
So what do you mean? Look what happened? What happened?
Well, look what happened. The market sold off really hard. I mean, after that.
But then you had a huge rally in October.
Well, you did.
Big rally in October.
Yeah,
when they were expected to not raise rates, Maria.
So I think that they don't. Look, the Fed does not want to surprise markets. I think it was her first test run on this one. Let's hope she gets it right this time.
The markets, they raise rates, the markets rally?
A lot of it's baked in, okay? Yeah. So if they don't raise rates, whoa, what does the Fed see? That's really bad. They raise rates, you might see a little profit taking. However, Europe is really underweight U.S. financials. So they're going to want to play, so any sell-off should probably be bought, especially in financials.
What's your favorite bank stock right now?
So I love the Carolinas. I love Yadkin. I love Bank of North Carolina. I love some of the acquirers out of Arkansas. I like, Home Bank and Ozarks. Not household names, but they're growing really, really fast.
Takeouts?
No, those guys are, most of them are the buyers. Yadkin is a very, very valuable franchise, and I think it's worth a lot more down the road as a takeout. They've been a buyer, but they've built a great franchise, a lot of value there.
Anton, always great to see you.
Always a pleasure to be here.
Thank you so much. Anton Schutz joining us, Mendon Capital. Up next,